Hello, everyone. This is Rich Lowry of Park Edge Advisors with our third quarter market and positioning update. Before we get into it, we do have a word from our sponsor. The agenda, first of all, we got some pretty good feedback saying that we should, at least on a few slides, update them regularly to make it easier to kind of track progress and provide some more continuity. And that was a good idea, so we're going to do that. We're going to try to stick with this particular agenda in the future. We update performance, update where we are in the economic cycle, see what our market regime indicator is telling us, take a look at what the economic regime indicator is telling us, and then we can go through any potential catalysts or callouts. So for performance review, here we have the all asset strategy against the Dow Jones Moderate Index. We threw in the Vanguard Balance Fund, which would be comparable in terms of moderate risk. And then at the bottom, the AFI or active fixed income strategy against the U.S. Aggregate Bond Index. A couple things to point out is that the all asset strategy is ahead of the Dow Jones benchmark, both in terms of performance, but noticeably less risk, which I think is the more important call out. So beta is a measure of risk. The S&P has a beta of 1. The Dow Jones Moderate Index has a beta of 0.6, and the beta for all asset is negligible. And a way to read that is to say that volatility in the S&P 500 or volatility in the Dow Jones Moderate Index really has had no bearing year to date on volatility of the all asset. So on a risk-adjusted basis, you want to take a look at not only what the return is relative to the benchmark, but the risks you had to take to get that. So that's pretty good performance, relative to our expectations, and we hope that continues through the balance of the year. And then same thing in the bond strategy. AFI is up on the year in what is likely to be the fourth consecutive negative year in the bond market, which is unprecedented. So the U.S. Aggregate Bond Index has a negative performance year to date. AFI strategy is up over 3%. But here too, notice the difference in risk. We have a fraction of the risk of the index. And if you take a look at it visually, here's the all asset against the Dow Jones Moderate Index. The moderate index is in the lower right hand, where in this case, the horizontal axis is beta, that's the measure of risk, and the vertical axis is return. Ideally, you want to be to the left of the benchmark and above it. In this case, it is. I wouldn't expect it to always be this wide. But this is an illustration of, not being constrained to a fixed 60-40 portfolio like the Dow Jones Moderate Index is, and not being limited primarily to stocks and bonds, having the ability to invest in any asset. Same thing for the bond strategy, AFI. Its benchmark is in the middle in green. And again, we're to the left, meaning less risk, and we're above it, meaning better return. So AFI is in the upper left, and we hope that continues. To review from last session, we said growth remains below trend, is kind of flatlined. Employment is beginning to weaken. The Treasury has been the predominant provider of liquidity, and they have eased financial conditions. And then markets are basically ignoring any probability of recession. And that continues to be the case. The composite of coincident indicators has weakened a little bit. Last time we said it was flatlining around 1.5%. Last couple of readings have been more like 1%. So it's not negative. You can't say recession is here until those go negative. But it's also certainly not robust growth that you might see, coming out of a recession or, heading into a new economic cycle. So that bears watching. Employment is beginning to weaken. There's several leading indicators of unemployment that we called out last time that said, look for unemployment to start rising. It has. I will caution that the unemployment rate itself is a little bit skewed by immigration. So the decline in payrolls cannot fully explain the amount of increase in unemployment. What else is going on there is that the denominator is increasing. The size of the labor force is increasing due to immigration, and it's causing a little bit of a distortion in the unemployment rate. But we'll continue to watch that. Treasury still is the dominant provider of liquidity. The next quarterly refunding announcement is coming up next week. We'll be glued on that to provide our assessment. That has the potential of either being a bullish catalyst, a bearish catalyst, or neutral. And rather than try to anticipate or predict what they're going to do, we're just going to wait for the numbers to come out and assess them once we know what they are. And markets continue to price in virtually no odds of a recession. It still remains less than 10% odds. In terms of where we are in the economic cycle, here is the composite coincident indicators. The last couple of bars we've added on have been more like 1% growth. Last time we said it was flatlining around 1.5% growth. So we really can't call a pending recession, which it's not so much the recession, it's the turn in the labor cycle that is the main thing. And that's not likely to commence until we see these numbers go negative, and they just haven't yet. A couple of sessions ago, we covered the residential construction. That's important in that it's highly cyclical. It's the most interest-sensitive sector of the economy, and the overall employment cycle is not likely to turn until residential construction employment turns. So the things to look at here are what's the relationship between units under construction and building permits. So the mechanical sequence is you have to get a permit first, then you see a pickup in residential construction, then you see new home sales. That's a mechanical sequence that can't be shuffled around. The call out we had a couple quarters ago was that units were just taking longer to complete. And the layoff cycle in residential construction is not likely to turn until units are completed and there's not enough stuff in the pipeline to keep the same size workforce employed. And this is showing that it's starting to turn. So the red line on the right-hand side are permits. Those are turning down, and units under construction are turning down. And if that relationship holds, that's likely to tell us when the residential construction employment cycle is going to turn. And that's likely to be the leading indicator on when the overall employment cycle is going to turn. Here, the left-hand side looks at the spread between the two, and you can see we're now reaching levels that we rarely reach, and when we do, it tends to be recessionary. And then on the right-hand side, we're looking at permits relative to employment, and the level of permits indicates that employment is about to turn. So these are some measures that we're going to watch pretty closely here over the next quarter. And here are two measures that have very good predictive ability of calling recessions. The so-called SOM rule and the McKelvey rule are based on different ways of looking at the increase in unemployment. And if unemployment increases a certain amount over a certain pace, they've had a very good record of calling recession. One of them is saying that we are currently in recessionary conditions, and the other's not. So it's a sign we're getting some weakening. I would again caution that these are both based on the unemployment rate. The unemployment rate itself is a little bit skewed by immigration, but we are seeing signs that labor is weakening. In terms of the market regime update, last time we said it was a low conviction quad two. Now we've been through or are in a phase transition, and this looks like a low conviction quad four. So let me explain what that is in case anybody is new to this. This looks at the largest, most liquid markets across the globe and across all assets. The green column headings indicate global stock markets, different global stock markets followed by volatility. The blue are commodities. Then in green, we have currencies. And in yellow, we have interest rates, both domestic and global. We have credit spreads. We have benchmark policy rates by central banks, et cetera. So what we're trying to do here is look across all assets and say, are they demonstrating a behavior that's most consistent with either quad 1, 2, 3, or 4? So this is a way for us to know what quadrant is the market in. So we do track what quadrant the economy is in or headed to, but markets are always trying to front run that. And regardless of what the economic data says, because that comes out with a lag, it's important to keep tabs on what quadrant the market is in. And you can see from the top of this page to the bottom, most of the things in the top are now different on the bottom. That's a phase transition where something goes from one state, changes to another state. So equity markets are primarily neutral. Volatility is starting to pick up. Commodities have gone from bullish to neutral. Phase transition is going on in currencies, and phase transition is well underway in rates. So if we had to sum this up, first thing we would call out is there are just too many neutral signals. Half of the indicators on the page are neutral. So you don't want to draw too many conclusions, or you don't want to have a strong conclusion based on so much indecision across all of global macro. But of the things that are demonstrating some signal, in other words, a green check or a red X, it looks most characteristic of quad 4. So this is something that we track every day. As this change, we're constantly evaluating our exposure. And this is a tool to say, what are markets actually doing? And then if we flip over to the economic regime, this is a tool that tells us what are economic conditions likely to do over the next 3 to 12 months. So half of the indicators are real economy variables like growth, inflation, employment, et cetera. The other half are financial economy variables. We haven't broken down where for each one it's scored. Are things getting better? Are things getting worse? And if you focus in the middle is where we kind of sum it up. So this is a way of saying, based on our tracking of the economic data, conditions are likely to get worse at the margin for stocks, better at the margin for bonds, better at the margin for US dollar, and currently are neutral for commodities and Bitcoin. So we're always trying to put the two together, is to say, what regime is the market currently in, and what are the odds basically that it remains in that regime? So if we were in, for example, quad 2, and the economic regime here was green, telling us conditions would be favorable, then our expectation would be that we would remain in quad 2. But currently, markets look like they're behaving slightly more like quad 4, and this is saying that conditions are likely to worsen. This tells us that we may have, a regime change on the way, given that last time, we were talking about quad 2. As far as catalysts, obviously the Fed is always a catalyst. And what we've been saying recently and said last time and are repeating this time is that the Treasury is really in the driver's seat, not the Fed. But now markets are pricing in 7 rate cuts between now and the end of the year, including 1 in September and a total of 3 by the end of this year. And our view is we don't think we're going to see all that. So that's going to be the big catalyst, next week. Does Jerome Powell confirm that the amount of rate cuts that markets are currently pricing in is consistent with what the Fed wants to see or not, or does it push back on that? This has the potential to change some of our positioning. And then, of course, the Treasury has its quarterly refunding announcement, or QRA. We did a piece that we emailed out to clients a couple months ago, I want to say in May. If you can't find that in your inbox and you want to take a look at it, let us know and we'll resend it to you. But the quarterly refunding announcement is where the Treasury says this is how much debt we have to sell. And here's the schedule of what we're going to sell in terms of the composition of, let's say, 2-year notes, 10-year notes, 30-year bonds, whatever. The reason this is so important is that deficits are at all-time record highs, and the main buyers of treasuries are not buying. The Fed is not buying, global central banks are not buying, commercial banks are not buying. So you just have a good old-fashioned supply-demand mismatch. You have a huge amount of supply, a record amount of deficits, aside from the World War II period and the COVID period, record amount of debt to sell, not as many buyers to absorb that debt. The net impact of that is likely to be upward pressure on interest rates. And, you know, this has the potential to be bullish, bearish, or neutral. If they continue to issue a disproportionately large amount of treasury bills, which don't drain liquidity, it'll be bullish and we'll change our positioning to reflect that. If, on the other hand, they shift the composition to issue longer term debt, which does drain bank reserves and liquidity, then we're likely to change our positioning to account for that. So it's not anything that we're going to try to guess ahead of time, but when the numbers come out, we're going to be ready to kind of break those down and you know, do what we have to do. And then finally, I would say just, you know, we have an election year coming up. Don't let the politics get into you know, the portfolio. There's no part in our process that factors anything in about politics. I'm not saying politics don't impact things, but it really boils down to growth, inflation, liquidity, et cetera. And we're still a long way away of knowing whether the election is going to have an impact on those. Our current positioning is broken down here. Here you can see pretty good balance among all the major asset classes. So we have still a lot in T-bills. We think 5% risk-free is still a good deal. And then we have currencies, bonds, and interest rate hedge that'll pay us if long-term rates go up. Our equities, our energy, the S&P High Quality Index, India, the domestic stock buyback index, the international stock buyback index, utilities, gold miners, and uranium. And, you know, commodities have been a good contributor, currencies have been a good contributor, and having the ability to have this kind of balance is, you know, both a factor in the performance, but also much less risk than the index. And in AFI, the active fixed income strategy, pretty good balance here. The bonds that we do own are 2 to 6 year maturity. Currencies have really helped us. We have the US dollar index and gold. We do have some junk bonds, but that has with it a credit hedge from defaults picking up. The foreign bonds we own are US dollar denominated. Mortgages are government backed, so they're high quality. And then we have some inflation protection and the same interest rate hedge that'll protect us as long rates go up. So the summary is that financial conditions still aren't tight enough. They're not restrictive. And that is going to make it hard for the Fed to claim victory on this last mile of inflation. So when you put resilient growth and sticky inflation together, our takeaway would be, you know, equities are going to have a very hard time justifying 2025 earnings expectations. Growth is not strong enough to support that, but growth is strong enough or resilient enough to delay rate cuts from the Fed. So Would not be surprised if there are no rate cuts in 2024, and would not be surprised if we get far less than the 7 that the market is already pricing in. The Treasury really can't keep kicking the road down the can, kicking the can down the road much further. They did that in the October meeting. They did it to a lesser extent in the January meeting. They did it again in the April meeting. And by kicking the can down the road, what I mean is that they have an enormous amount of bonds to sell. If they sell anything with a 1-year maturity or longer, that's a negative impact on liquidity. And instead, if they issue T-bills, it has no impact on liquidity. So what they've been doing is shifting the composition more and more toward Treasury bills, which don't drain liquidity. And the reason that's kicking the can down the road is they can't keep funding the government with short-term paper, 2-3 month paper. What they should be doing is selling long duration bonds while term premiums are still very cheap relative to historical standards. But politics could play a role in that, where the current Treasury Secretary could be saying, "I'll worry about that later. I'll worry about that after the election." So our view is that they should be selling long-term debt, but they're not. When the QRA comes out next week, if it's bullish, we'll change positioning to reflect that. If it's bearish, we'll change positioning to reflect that. We still think that is a major catalyst. And then investors have gotten a bit off sides. So when we track institutional managers, hedge funds, et cetera, they're overweight risk. They're doing it on leverage. They're unhedged relative to how much hedging exposure they have. And when that happens, where everybody is bullish and positioned for it, it just leaves very little margin for error for anything to come along and disappoint. So for next steps, there is a link that was emailed out along with this video that has a live sync to my calendar. I hope you sign up for a one-on-one. We could go through any questions you have in this material. We can talk about anything you want to talk about, your own personal situation, anything you want. So I hope you take advantage of that. Also, I would encourage everybody to update their risk profile. Even if you think it hasn't changed from last time, it would help on our side to get an update. And if all we do is verify that it hasn't changed, there's nothing wrong with doing that. So I would encourage everybody to complete the Orion risk assessment. And as we connect for the one-on-one, we have some new strategies that we are in the process of rolling out. We can discuss what those are and whether it would make sense to incorporate any of those in your overall mix. So with that, I want to thank you for tuning in. I hope to connect with you soon on a one-on-one, and have everyone a good day. Thank you.